Hi, everybody, and thanks so much for joining today. My name is Marty Kerriman. I'm a principal at Bekaert, focused in our federal credits and incentives group. We've got a great presentation for you with my colleagues. I think 4 of us are on video, 1 may be calling in, oh, there she is. And we will be we'll be introducing ourselves and going through a variety of topics today, mostly focused on some of the practicalities that we have seen as we've gone through the PPP process and the multiple iterations of the ERC process. But I'll turn it over to some of my colleagues. Maybe I'll turn it over to John first to introduce himself.
Great, Marty, thanks. And I'm John Carpenter. I'm in the advisory practice at Bekaert, and myself, and I'm going to hand it off to my colleague Danielle DeSonia, but the 2 of us and others have been up to our ears in PPP for 13 months now, so we're going to touch on PPP. Danielle?
Yep, thanks, John. I'm Danielle. I'm a manager in the advisory practice. Even before PPP, I work with John closely on a day-to-day basis, so PPP is no different. Somebody else we've been working with is Evan. I'll turn it over to you.
Hey, everyone. My name is Evan Usher. I'm a senior associate in the advisory group as well. I've been working closely with Danielle and John for a while now on the fun topic and ever-changing topic of PPP. And I will pass it over to Deb, who's been helping out on everything.
My name is Deb Walker. I've joined Bekaert about 8 years ago after working for a number of accounting firms. And I work on the technical side for both PPP and ERC. So with all 4 of these people, good to be here.
Great. All right, so I'll just talk about this at a very high level. As mentioned at the outset, I think many of the people on the call who've joined today have probably been through different discussions on PPP and ERC. Our focus today is to cover that at a high level to make sure we're all level set, but then at the same time, we're pretty far down the road now. So I think we've learned a lot by having conversations with multiple clients over the last year, working with each other and how these different incentives, how they interplay and how we can maximize actually the incentives as well as we think about how we go about applying for forgiveness for PPP, talking a bit about how the second draw process has gone and what some of the practicalities are there when you're looking at ERC. We'll talk quite a bit, I would say, from the employee retention perspective of the differences between the 2020 and the 2021 credits, with an added flavor of a lot of the questions that we're hearing in there that some of the some people that haven't been through before wouldn't know about. And then we're going to talk a little bit at the end of some of the newer incentives, specifically with respect to shuttered venue, and then also the Restaurant Revitalization Act. And then at the end, we'll just again summarize again what some of the strategies are for maximization and what our approach is as we've been talking to clients and what we've learned. So I'll leave it there and I think kick it back to Danielle.
Yep, so we'll start with PPP, as Marty said. We'll start with the first slide. Changes to the covered period. This isn't new. These changes happened a while ago, a couple months ago in January. Something we've been seeing is people not considering what that means. So if you change your covered period to something between 8 and 24 weeks, if you remember, you used to have 2 options, 8 or 24. Now we have anything in between there. You're gonna have to consider the how that's gonna affect your safe harbors, and that's for your salary reductions and your FTE reductions. It's also gonna affect how you're doing your per employee cap. So if you're doing, say, a covered period of 10 weeks, you're gonna take your $100,000 cap, divide it by 52 weeks, and multiply it by 10 weeks. You can't use that 24-week cap if you're not calling your end of your covered period 24 weeks. So just keep that in mind as you're filling out your forgiveness applications, and you can choose your covered period now, and to really consider what that means as you do it. Another tip, which seems obvious, is use the money. So we've had a couple clients come to us and say, I've got all this money and I stopped paying my rent and I stopped paying my employees and this and that. Don't do that. You got your money for a reason and it's to use it. You've got 24 weeks to use it. And you can use it on a bunch of different things now, which I'll touch on in a couple bullet points, but there's no reason not to use your money. That's why you got it. If you don't use it, it's not going to be forgiven. It's going to turn into a loan, which it's a good loan, but if we can get free money, let's get free money. Another question we get a lot is, do I have to include every single eligible expense? And the answer is no. If you can include just payroll, include just payroll. Just because you have utilities, just because you have rent expenses, doesn't mean you have to include them. Now, I'll put an asterisk next to that, and when we start talking about how this plays with ERC, you'll have to keep this in mind. But you don't have to dump everything in the kitchen sink at your forgiveness app to get your forgiveness. We recommend keeping it simple if possible. So the additional non-payroll expenses, again, these were introduced back in January, and they include things like covered period operations, property damage costs, supplier costs, and worker protection expenses. You probably don't need these costs, but if you're really tight on that forgiveness and you're not sure if you can get your entire loan forgiven, then let's look into these costs and see what we can do. And then finally, another thing to keep in mind is the simplified process for loans over 150,000. I'm sorry, under 150,000. You will be filling out something called the Form 3508S, and all this asks you for is your loan amount, the amount that you want forgiven, and the amount of the loan that you spent on payroll. The SBA can always come back and ask for more information, which you should have. However, you don't need to give that with your application to the bank. Evan, turn it over to you.
All right, well, thanks, Danielle. And as everyone is probably getting a little uneasy about the loans that are over 2 million because you haven't heard anything from your bank or from the SBA, just know that that's commonplace. We've worked over 1,000 applications over 2 million, and for all the banks that we're working with and for our CB clients, they haven't heard anything. So, and for all the banks that we're talking with, they haven't even heard of all their bank committees of these $2 million loans being paid out by the SBA. The SBA and the banks are requiring you to fill out these 3509 and 3510 forms, which is the loan necessity questionnaire. And in those questionnaires, once you fill that out, the SBA is usually asking some questions, either about the FTE counts or why you use the EZ, or just or government orders or several other topics. So don't be surprised that if the SBA comes back and asks for some additional questions on that. And with the banks requesting the 3509 and the 3510, just know that the banks really don't know when to request it. The SBA hasn't really given very clear guidance to the banks to tell them when to actually request that form. But just know it's coming, and feel free to reach out to your bank to ask them for that form. But just be prepared that you only have 10 days to actually fill it out. So just know that once you get that form, just to be ready to knock it out, and you'll probably want to get with your CPA as well as probably your legal counsel, just to go over what's being put in and how you can answer those questions correctly. And to kind of add on to what Danielle was saying, for some examples of some Cherry Bekaert client work, a majority of the clients that we've worked with, we tried to use 24 weeks worth of payroll. That's usually the easiest for the bank to review as well as the SBA. But with, as Danielle was saying, with the ERC for 2020 and for 2021 as well going forward, we've been bringing in some other costs such as rent, utilities, mortgage interest, new covered expenditures as well. But the easiest way to get full forgiveness is typically just doing payroll for 24 weeks and just going with that. Right, and next we're going to talk about the PPP application process. Back to you, Danielle.
So my biggest tip or trick here is, if you have not gotten your second PPP loan and you think you're eligible, apply early. Technically, you have until 5/31. However, if the funds run out before then you're out of luck. And all indications are that it will run out before that. You also want to keep in mind that your bank or your lender may stop accepting PPP2 applications before 5/31. You know, they may have a big backlog. They may not want to just start down the road of approving an app if the money runs out. So keep on communications from your lender and the SBA releases to see when that money's going to run out and when you need to apply. The last thing I'll say is before you apply, think about your revenue reduction. You need to have a 25% reduction between one quarter in 2019 and the same quarter in 2020. Don't just throw any 2 quarters at them. Actually look at your P&Ls and make sure you meet that test before you send it in. If you send in the wrong quarters, you know, if you meant to send Q2 and you send Q3 and you don't meet it, you're going to get sent back and it's going to take longer to process your application and you may not get your funds in time. So keep an eye on your P&Ls before you actually send your application to your bank.
Yeah, and also to add on to that, to talk about the employee limits, this is probably just a refresh of one of our earlier webinars, but just to kind of remind you, if you're receiving your first PPP loan, then the limit is 500 employees, and that's all employees. That isn't considered full-time. It's just gross number of employees per month, average over 12. And then for your second draw loan, so that this would be your second PPP loan, it is 300 employees. And you use several periods. You can use several periods to calculate that, and to also calculate your costs. You can use calendar year 2019, calendar year 2020, and then the trailing 12 months 2021. And then the one kind of difference here is that you can calculate your costs with a trailing 12 months. But you can also calculate your employees for calendar year 2019 or 2020. So if your costs are higher now than they were in 2019 and 2020, then you can use those costs, but use an employee count for 2019 or 2020. And then the eligible costs for those calculations are payroll costs for all employees capped at $100,000 annualized payroll. And then also 401k, health insurance, life insurance, disability insurance, and vision insurance as well. All right, well, I will pass it over to Marty to talk about the ERC.
All right, thanks a lot, Evan. Before I even get into the rules, let me answer the one question that a lot of people asked beginning in January and still do today. If I got PPP in 2020 or I'm getting PPP now in 2021, is there really any benefit to me taking ERC? The answer is definitely yes. The reason being the amount of PPP coverage, the amount of wages that it will cover is generally less than the amount of total wages in a quarter under the way the rules work. So to the extent you are an eligible employer for purposes of ERC, the remaining wages can then go into the ERC calculation. So it's almost like another layer of benefit on top of PPP, and it was intended to be that. If you look at the pronouncements by Congress as they came out with the rules at the end of December that allowed taxpayers who had taken PPP to go back and look at ERC, it is the intent to have taxpayers take advantage of both if they can. We're in unprecedented times in the economy, and it is the intention of the government to let companies take advantage of these programs and avail themselves of whatever benefits they can in order to help themselves out. When I think about ERC, I think about 5 credits instead of 1. What I mean by that is in 2020, there's 1 credit that you calculate among all 4 quarters. And in 2021, there's almost 4 separate tax credits that you calculate in each quarter. The ERC is a refundable payroll tax credit. But when I say refundable, the intention is to have that tax credit actually be larger than the amount of payroll taxes owed to the extent you're one particular type of company. And so anybody who's listening to this should keep in mind that when you take advantage of the ERC program, your benefits may be much larger than the actual payroll taxes you owe, meaning there's a refundable amount back to you. But it is a credit that is intended to apply to companies that have been harmed by COVID to the extent, and I'll get to this on the next slide, but to the extent they have had a decline in their gross receipts, or if the government, through any mandated behaviors that are limiting commerce, travel, group meetings in the economy, are disrupting the business, causing what the statute refers to as a partial shutdown. To the extent your business can't do business the way it could before, you may be an eligible employer that way as well. The credit itself, to the extent you're an eligible employer, meaning one of those 2 tests I just described, for 2020 is equal to basically 50 cents on the dollar for the amount you pay to every employee you have, to the extent you are 100 or fewer full-time employees in total. It's basically a 50 cents on the dollar credit for the first 10,000 you pay. In 2021, it's a 70 cents on the dollar credit up to the first 10,000 you pay to every employee you have every quarter. So that $10,000 clock starts to rerun itself at the beginning of every quarter. Now, when you hear the word retention credit, for most companies that are larger, meaning for purposes of 2020 credit that are greater than 100 full-timers, or in the 2021 credit, greater than 500 full-timers, you're really only allowed to include the wages that you pay to retain people, meaning they didn't have the work to do, so you're paying them instead of them going off to unemployment, and you get a credit for that. But if you're a smaller company, and that smaller company being 100 or fewer full-timers for purposes of 2020, or 500 or fewer for purposes of 2021, you can actually include the wages you pay to everybody. And I find that a lot of the companies that claim PPP, they're now looking at ERC, fall into one of those two smaller company regimes. And they can see their benefits being as high as $5,000 per employee for the 2020 credit, or even as high as potentially $28,000 per employee as they look at the benefits they can have in each quarter of 2021. Why don't we move to the next slide? All right, so again, I alluded to this, but the test in order to take advantage of the employee retention credit is, are you an eligible employer? Meaning, are you harmed by COVID due to a decline in gross receipts, significant decline? That significant decline in 2021 means that in any quarter of 2021 compared to that same quarter in 2019, is the business on a control group basis down by more than 20% from a gross receipts perspective. For 2020, fewer companies meet the gross receipts test because it's a harder test to meet. You actually have to be more than 50% down in any quarter compared to where you were in the same quarter in 2019. Another little trick of the trade here, rule of the road, shall we say, is that companies need to keep in mind is, though, for both 2020 and 2021, if you qualify under the gross receipts test in quarter one, or say in any of the quarters based on the quarter actuals compared to those quarters in 2019, you're going to automatically qualify for the next quarter as well. The rules are a little different in operation between 2020 and 2021, but that's definitely true. You will absolutely qualify for the next quarter, potentially even three in quarters in 2020. Government mandate test, that's going to be more prevalent, I think, in 2020 than it is in 2021. There were more rules restricting commerce, travel, and group meetings last year. Nevertheless, when we think about it from an perspective, in the hospitality industry, restaurants, they're still potentially under some type of government order with respect to capacity limitations, et cetera. But we can talk about some examples later. But the point being, I'm finding more companies in 2021 qualifying under the gross receipts test, and potentially more companies qualifying under the government mandate test in 2020. I'll leave it at that, and we'll move to the next slide. And I might be handing it over to Deb here, which I think I am. Hello.
Thanks, Marty. So one of the things we've had a lot of discussion about recently is gross receipts if you're a non-taxable entity. For a taxable entity, it's pretty straightforward. It's the gross receipts that are used for your method of accounting based on the regulations defining gross receipts for Code Section 448 purposes. Now, for tax-exempt clients, they actually look to the gross receipts that you include on your Form 990. And unfortunately, there are a number of things that are not as favorable for tax-exempts. We do the most prevalent one, I think, or the most harmful one, is the fact that if you sell securities, it's the proceeds, not the gain, that go into your gross receipts test if you're a tax-exempt entity. Now, we've talked to the IRS about this and explained that this is really not fair, and we have heard that they're supposed to give guidance. But until we get more information from the IRS, unfortunately, we have some very difficult rules to work with. The PPP loan proceeds, whether it's a disbursement or loan forgiveness, is also a tricky one. And I believe it's clearly a loan forgiveness. That's what happens to taxable employers. The reason some people think it may be a disbursement is some tax-exempt or tax-exempt employers account for their PPP loan as a grant and not as a loan. So again, we hope to have some more guidance on that. The next difficult thing we run into is controlled groups. controlled groups, you have to test everything on a controlled group basis. How much you pay employees, how many employees you have, what your gross receipts are. And generally, the test is the greater of 50% for a parent subsidiary group. But if you have any entities other than a employer corporation, you still test as a parent subsidiary, and there's also the brother-sister structure. The brother-sister structure is very favorable. If you're not a parent sub and you get into the brother-sister structure, it has to be the same 5 or fewer that own 80% or more of 2 entities. The last 2 bullets here we really don't run into very much. Mostly we spend time looking at percentage ownership and determining the control group analysis, but the affiliated service group is a rule that's been in the Internal Revenue Code for probably 30 years. It's a retirement plan discrimination rule, and generally you have to have service organizations being engineers, architects, doctors, lawyers, accountants, and aggregating those with other entities with whom they render services together. And then Congress got a little frustrated because people could get around the affiliated service group rules, so then they added a management function rule and made them an organization for which management functions are provided as also part of the affiliated service group. There is really no way to know whether you're going to be an affiliated group until you sit down with all your facts, the facts being the percentage ownership and who owns that. And now the good news for tax exempts, there are no affiliated service group rules for tax exempts. It would not surprise me that some get issued with additional guidance because there are rules in the retirement plan context, but nothing in the ERC context. Okay, so that ends the controlled group, and the next part we go to is the full-time employee count. This is so silly to me because it's different than PPP. PPP uses 40 hours of service, ERC uses 30 hours of service. And quite frankly, that's because PPP is administered from small business and they didn't want to use IRS rules. And of course, ERC is administered by IRS, and so they do want to use IRS rules. So these are the same rules that are applied in determining whether you're an applicable large employer for providing health care benefits to your employees. And then in some beneficial provisions, if you're not in business for all months in a calendar year, then you can look at the months during which you're in business, and the regulations even go so far as to say if you're in business for half of the quarter, you can extrapolate to be in business for a whole quarter. So they went a little bit overboard in the full-time employee count rules.
And hey, Deb, let me interrupt you and ask you a quick question with respect to the control group rules. One thing we've been dealing with quite a bit that we should probably make the listeners aware of is the private equity context and what we've seen there, and maybe a little bit of your insight there in terms of how we've been able to actually take advantage of the ERC, despite the fact that a fund may own a variety of portfolio companies, but does not always have to aggregate them together under the rules.
I'm glad you mentioned that, Marty, because I should have noted that if you are not all C corporations, then you only look at trades or businesses. So for each entity, be it a partnership, a corporation, an S corporation, a trust, whatever that entity is, you look at that entity and you decide if that entity is a trade or business. And the trade or business is something that operates continually, regularly, in trying to make a profit. That's based on a Supreme Court case, which is 30 years old and really not contested by anybody. And therefore, the IRS follows those rules and has issued guidance looking at those rules. But if you are not in a trade or business, as Marty's pointing out, many private equity funds, the funds themselves, only do investments. And in the Supreme Court case, they focused on the fact that it doesn't matter how actively you look for investment. If all you're doing is investing and acquiring businesses and selling businesses, you're not in a trade or business. And because you can look through, if you will, just eliminate the fund from your calculation or from I draw pictures when I want to know who owns what. eliminate the fund from your picture and then go up and look and see. And often those funds are held so broadly that we don't have a parent subgroup and we don't have the same 5 or fewer owning 80%. So that ends up meaning that the portfolio companies can in fact stand by themselves in many situations. We have a whole memo. We'd love to talk to you about it more. There was a PBGC case, Sun Capital, which has really nothing to do with the Internal Revenue Code. It's a pension benefit guarantee case. It had to do with funding a defined benefit plan. And the PBGC lawyers came up with an idea that said you do need to aggregate. And in fact, they won and they lost, but in the end, it was very clear that that case only applied for PBGC and not for the Internal Revenue Code. So when people bring up Sun Capital to me, I say, well, it's really not applicable. You need to go back and look at these other cases and this other guidance from the IRS. So thank you, Marty.
Sure.
The last one I want to talk about is acquisitions, dispositions. The IRS has a special favorable rule here that if you acquire a company, of course, when you acquire a company, so it's not in business the whole quarter of 2019, and you're comparing your 20% gross receipt decline or your 50% gross receipt decline, you can assume that you owned that business that you acquired. And very often you do have those records from the former owner, and you can determine whether there's been a decline in gross receipts. So it's not always just your gross receipts. You sometimes add the gross receipts from an acquired business, which helps you to meet the test. Now, the most important thing before I turn it back over to John to talk about shuttered venues and restaurant revitalization is the monetization of the credit. How do these employee retention credits turn out to be money in your pocket? And the IRS and Congress wanted to get the money in your pocket as quickly as possible. So the first thing you can do is offset your payroll tax deposits that you would otherwise make. So once you know that you qualify for ERC for a quarter, you can begin to reduce payroll taxes that you would otherwise pay. That's payroll taxes for federal income tax withholding, Social Security, Medicare withheld from an employee, and the employer's Social Security and Medicare. So the employees still get credit for all of the taxes. It's just you don't have to send it to the government, so they can send the employee retention credit back to you. So that is the most favorable way, the way the IRS wants you to do it. But many times you don't know until the very end of a quarter as to whether you're going to qualify for ERC. And so then it becomes you don't have enough withholding for employees and employers during that quarter to get everything you're entitled to. So on the right-hand side, the last two bullets, you can claim them as wages under Form 7200, or you can claim it on your Form 941. So the 7200 is a form that can be filed as many times as you want during a quarter, but once you file your Form 941, then you cannot use the 7200 for that quarter anymore. The Form 941 is the reconciliation form for all the credits and all the payroll tax deposits, and average quarterly wages is what you can claim as an advance, average quarterly wages for 2019. But if in fact you claim that much, you may end up paying at the end of a quarter. So when people use the 7200, it's really better in my mind to not apply for the most that you could possibly get. It's either to use it after you know what your credit is because you've calculated the credit for the first couple months of the quarter, or to estimate what it is on a fairly close basis. So, and if you don't use the 7200, we have many people that just claim it on the original filed 941. If you can't claim it on an original filed 941, then you will have to do an amended 941. And that is a longer process in getting your funds. So you want to do everything you can, and we spent all month working with payroll providers, making sure that the Q1 2021 credits have been claimed on the original filed 941. And of course, with a PEO, a professional employer organization, They file payroll taxes for people, but they attach a Schedule R. And all of this information is included on the Schedule R. So the PEOs are sometimes a bit harder to work with, but we do the same thing with the PEO that we do with the payroll. So that's monetization of the credit, lots of different ways to do it. Let me turn this over to John now.
Great, Deb, thank you very much. And I'm going to spend a few minutes talking about two other grant programs, one of which just opened yesterday, finally, and another of which is scheduled to open later this week. But separate and apart from PPP as well as from the ERC, both the CARES Act and the Consolidated Appropriations Act have rolled out two additional grant programs that are targeted at certain specific industry groups, and we'll go through those right now. First is the Shuttered Venue Operator Grants, or we'll just call them the SVO grants. This grant program was rolled out in the Consolidated Appropriations Act, which was passed basically around Christmas time, and it's targeted for or targeted toward entities such as you see here: movie theaters, museums, and live venue operators. And the general requirements that entities need to meet in order to be eligible need to be in operation, need to have been in operation as of February 29th, 2020, have fewer than 500 employees, and should be able to show a revenue decline of at least 25%. That revenue decline demonstration is generally not very hard in this industry, where obviously most live entertainment venues have been closed down for the last year. We don't really have time today to talk about some of the other specific requirements that go along with this, but everyone should be aware that there are specific requirements, type of venue that you may operate. Requirements could include fixed seating, could include how you're open to the public and the type of entertainment that's provided. But these are very attractive grants. Grant amounts are based on revenues, not wages. So if you are an eligible operator, you could be looking at a grant up to 45% of your 2019 gross receipts, up to a maximum of $10 million. So again, a pretty healthy amount for small operators. Currently, SBA, and this program is administered by SBA. Currently, SBA for the first few weeks is going to be making grants only first to entities that show a 90% year-over-year revenue decline, 2020 versus 2019. Then in a couple of weeks, for the following 2 weeks, they will be making grants only to entities which can show a 70% revenue decline. And then 4 weeks out is when the rest of the grant money will start being issued to all other operators who show something less than a 70% revenue decline. Be aware that the SBO grant money can be used on eligible expenses that really vary a lot and do not have the same sort of restrictions that PPP has. So SBO grant money can be used on wages, benefits, rent, debt service, at least on debts that were in existence prior to February of 2020, supply costs. They can be used to cover past due expenses that were incurred during the last year, and now you want to catch up and bring them current. It can be used for reopening expenses. Really, the variety of expenses that can be covered with these grants is quite broad, much broader than in PPP. And as we note there at the end, although the opening of the portal for this program has been delayed several times, I think many industry experts predicted that these grant applications would start being accepted perhaps in mid-February, The portal finally did open yesterday. So with some delay and fanfare, it is now underway. These are grants, not loans, which means there is no repayment. This is not like PPP where it's a loan, but then you apply for forgiveness. These are grants from the government, but there is some reporting that goes with it. As with most grant recipients, SBA will require periodic reports of how the money is being spent. And these grants also have an audit requirement in that if your grant consists of at least $750,000 in a calendar year, then at the end of that year, you will be required to get what's called a single audit, and that'll have to be submitted to SBA. For anyone who's not familiar with single audit requirements, feel free to contact us afterwards and we can walk you through that. Next, let's talk about the other grant program, which just got rolled out, and that's the Restaurant Revitalization Fund. This grant program, total of $28 billion has been appropriated by Congress under this program. And about $9.5 billion of it is reserved for businesses that have less than $1.5 million in 2019 revenue. There's some different breakdowns within that. There's even a set aside of about $500 million for businesses that have less than 50,000 of revenue. So this is targeted towards small operators, as is PPP, as is the SVO grant. These grants, like the SVO grants, are tax-free, have no impact at all on the deductibility of your expenses. They are available to establishments that were in business both prior to February 15th of 2020, and unlike PPP and unlike the SVO grants, these are even available to restaurants that have opened during COVID or after, if you want to call February 15th the official opening of COVID. I'm going to jump over to the right side and let's first talk about the eligibility, what kind of establishments are eligible for these restaurant revitalization grants, or we'll just call them the RRF grants. Well, the statute passed by Congress said that the grants were going to be available to any place of business in which the public or patrons assemble for the primary purpose of being served food or drink. So you see the list there, clearly including restaurants, food stands, food trucks, caterers, brew pubs, etc. And although some of you may look down the list and say, well, you know, is every brew pub open to the public? Are all wineries and distilleries open to the public? And Congress's intent and SBA's execution here was to make these as widely available as possible, but with the notation that for bakeries, brew pubs, tasting rooms, tap rooms, breweries, wineries, distilleries, and similar, they must be able to document that their on-site sales to the public comprised at least a third of their 2019 revenues. If they were not open in 2019, then SBA is going to look at their business plan or the intent of how much of their sales were going to be to on-site patrons, not just for shipment off premises. Much like the SBO, this is a grant program. It's being administered by SBA directly. This is not going through the banks like PPP did. Just last night, there was an announcement that the portal for this grant is supposed to open this Friday, April 30th. That's not a promise because there were certainly delays in the opening of the SVO portal. So we're hopeful that this portal will in fact be open on April 30th. Just like there are set-asides in the opening weeks of SVO for businesses that experienced either a 70 or a 90% decline in revenue, SBA has set up then in the RRF grant program for the first 3 weeks although any business can apply for the grant, and we would very much encourage eligible businesses to go ahead and apply as soon after April 30 as you can, be aware that in the first 3 weeks of the grant program, SBA is only going to be funding grants to the 3 types of ownership outlined there on the left side: woman-owned businesses, veteran-owned businesses, and businesses owned by what SBA terms socially and economically disadvantaged individuals, which can cover a variety of ethnic groups, including African Americans, Asian-owned businesses, Hispanic-owned businesses, and there's they will be checking ownership documents to see that the business is at least 51% owned or controlled by individuals who meet that socioeconomic criteria. The maximum grant under RRF is $10 million if you have multiple locations, $5 million if you have only one location. Eligible entities are limited to only 20 locations. So if you operate more than 20 locations within an affiliated group, then you are not eligible for RRF. Let's go to the next slide. The grant, the calculation of the grant, fairly simple, but there are some nuances to it. Basically, for businesses that were opened for long prior to COVID, the grant amount is going to be your 2019 gross receipts minus your 2020 gross receipts minus whatever you received in PPP loans. And that is not measured based on whether your PPP loans have been forgiven or not. It's simply whether they were funded. So again, basically, it's the drop in gross receipts 2019 to 2020 less whatever was covered by PPP loans, be they first draw or second draw. Not going to go through all the nuances. If the business opened in 2019 or opened in 2020, there's some adjustments to those calculations to account for the fact that the business was not open prior to 2019. There is provision that grants can be made to businesses that were not even open prior to the start of COVID. So businesses that may have opened even a month ago or a couple of months ago and had no revenues can get grants to cover eligible expenses up through March 13 of 2021. Much like the SVO grants, what can these grants be used for? Well, it's very broad. Payroll, mortgage costs, rent, utilities, maintenance, food and beverage costs, other supplier costs, benefits, the construction of outdoor facilities. Very broad and no set requirements that a certain percentage has to be used on one category or the other of these types of expenses. The expenses can be paid out over actually almost a 2-year period, covering anything incurred from February 15th of 2020. That's looking back a year, obviously, as well as looking forward almost 2 years. So you can be looking to cover expenses up through the exact date is March 11th of 2023. How will, if you're not applying for forgiveness, how do you report how you spent the money? Well, the details still not exactly crystal clear, but SBA has indicated that there will be some kind of a reporting mechanism set up where eligible businesses will need to report how they've spent the money no later than the end of this year, 12/31. Excuse me. And if they're reporting expenses beyond 2021, then they'll need to make reports at least once a year going into 2022. So more details to follow on how that expense reporting is going to be handled. Currently, there's no mention of whether single audits will be needed on these grants. Stay tuned. We'll see whether whether those details get released later. And with that, I think Deb, it's just going to you or Marty.
I'm going to talk about coordinating the PPP loan forgiveness, CARES, and ERC, because of course you can't use the wages for any of these things. Now, while you can't use the same wage dollar, you can use the same payroll, you can use the same time period. So what we tell people is first allocate your money to ERC, and that's a little counterintuitive, but you can often reach your maximum $10,000 per quarter or per year amount with the ERC. And then we, in our calculations, when we're doing ERC, we come forward with funds available for the PPP forgiveness. We do the same thing with healthcare costs. Often we don't use healthcare costs. That saves everything for PPP loan forgiveness. So we look first for allocations before the loan disbursement date, and then we start allocating during the covered period, first to ERC and then to other items, keeping an eye on how much is going forward to be used for PPP and how much we know, of course, how much we need for PPP, because we know our PPP loan forgiveness, our loan amount. We know the other expenses, or an estimate of the other expenses that we think will be incurred during the covered period, and what 60% of the loan amount is, so we know what we need for wages. And of course, with the PPP side, we get more types of insurance, disability, life insurance, we get retirement plan contributions, all of those things in payroll costs that are not included in wages. And finally, we come back to the ERC wages. Anybody that hasn't reached the $10,000 limit, we then look for healthcare costs and allocate them up. And what you'll find is usually your highest paid people, their wages are being used for PPP forgiveness. You're very low paid, your part-timers, your people who only work a few weeks for you, almost all of that comes through ERC. And in that way, you maximize it. The payroll companies and sometimes the PEOs, they just say, tell me what you want this payroll to go to. But if you allocate the entire payroll to either ERC or PPP forgiveness, you haven't maximized one or the other, or perhaps both. So you really have to look person by person, paycheck by paycheck, and make some allocations. And in that way, you do, in fact, maximize it. So, and the last slide here emphasizes the importance of coordinating your wages with everything else that you get credits for, including the paid sick and family leave, WOTC, R&D credits, those types of things. Again, the PPP2 covered period is going to be the tricky one, because there you actually have wage ERC time periods, and PPP, the entire quarter is going to be wages you're going to have to allocate. But with that, I think the biggest message is we start with ERC, but let me turn it to Marty.
Yep, just to maybe recap and give a couple of thoughts and maybe some simple takeaways that I keep hearing from clients in terms of like how to think about this stuff. Just simple questions they ask me all the time. Hey, I have a PEO. Am I really entitled to this thing? The answer is yes, definitely. And as Deb just alluded to the extent you do, that PEO will be happy to report the credit that you tell them about, but they're not going to do any work behind the scenes in terms of allocating your PPP amounts appropriately among your employees to maximize your ERC. So keep that in mind to the extent you're worried about paying some amount of fees in order to get some of this work done, or even doing additional work on your own. The PEOs are just going to rely, for the most part, on what you provide to them, as opposed to you doing a careful maximization and coordination among all these things. Here's another thing to think about. As you're thinking about gross receipts, PPP forgiveness counts as gross receipts. So to the extent we're looking at our gross receipts through 2021 and we're comparing it to 2019, and we're thinking about when forgiveness might hit, we should think about that in terms of which quarters we're going to qualify for ERC. And if we got that PPP forgiveness in a time where we were going to be 20% down, but now we're not, we just think we can appropriately plan around that. So that's something I think that's very important to think about, maximizing your benefits when it comes to that. Another thing I've heard from clients as well is, to the extent in 2020, say for instance, I have 101 full-time employees. Is there really any benefit for me to even look at ERC, because I can only include wages I pay to people not working to the extent I'm an eligible employer? I think the answer is yes. for two reasons. One, you can still include the amounts you pay for furloughed employees, so their health plan expenses would qualify. But even more than that, I like to put myself in the mindset of a company that was in existence right when COVID hit last year, March 13th through the end of April. Maybe everybody has to work from home. In general, working from home is not going to make you an eligible employer if you can comparably do what you could do from the office, but maybe you couldn't in the first 6 weeks, something like that. Maybe there was not enough connectivity. Maybe everybody didn't have a laptop. Maybe you're an R&D company, you couldn't get in the R&D lab. So if you're not an essential business and you can work from home, I think there's still an opportunity to pick up a portion of the wages you're paying to people to the extent they didn't have the work to do and you kept them on, and you're paying them a full salary. The other thing to keep in mind as well is the one thing that changed when these rules were, ERC was enhanced and pushed into 2021, is that the statute of limitations was also extended for 5 years, meaning that having a good what your restrictions are, the government mandates that are causing you to be an eligible employer, context where law firms couldn't go to court. The courts were closed or jury trials were restricted, but they might have switched their practice and focused on something else and made some additional revenue there, but their entire docket of what was done before was slowed down. Can they still qualify? I think the answer is yes in that case, and it requires a look at. So just because your gross receipts might go up a little bit compared to where they were in 2019, if you're subject to government orders that are actually restricting, causing disruption, causing a partial shutdown of your business, it's worthy of looking at, and don't count yourself out. With that said, everything everybody said was, I think, really good from a practical standpoint, rules of the road, what we've learned. Again, we want to coordinate what we're doing from a PPP perspective with what we're doing for ERC. Yes, wages are the easiest thing to get forgiveness on, but to the extent you have the ability to claim something other than wages and you could get more of an ERC, that's something worth looking at, and we can think about that with you as we think about forgiveness. If you're thinking about Restaurant Revitalization Act, go for it. Don't wait. If once that becomes available, if you haven't claimed ERC yet, we can figure that out after. But take advantage of full PPP. Take advantage of restaurant revitalization, and take advantage of ERC as well. From our perspective, what we're doing is having these conversations. We're trying to pull together a nice plan for companies that have multiple sources of funding benefits available to them, helping them maximize that, helping them allocate it, the PPP to the employees in a way that maximizes ERC, going through the organization charts, making sure we understand what you have going on from a control group perspective, because the SBA rules are different than the ERC rules. But all of this is something that we've worked on every day for the last year, and we have more calls today and we have more tomorrow, and we learn more every day. We understand what it takes to document this, how it takes to get this stuff turned around, what the different payroll companies want to see in terms of the best way to monetize, how we format information and give it back to them. So all of this works together, but it's nothing to be afraid of. It is intended by the government to provide benefits to our clients, to the companies that are out there, and everybody listening, to the extent that you qualify. Deb?
Marty, I want to just highlight one thing because we've had a question about it, and it's something that I actually hadn't thought of until we got into this. The PPP-1 loan proceeds are not in gross receipts. The PPP loan forgiveness is in gross receipts. So Marty's point was that you need to time when you apply for forgiveness. Of course, you don't know when you're going to get forgiveness, but what you want to do is, if you can, and you don't qualify in every quarter, you want to time your forgiveness when you hope you will get forgiveness with a quarter that you already qualify for ERC, perhaps by looking at a prior quarter's gross receipts.
Okay, excellent. And thank you, Deb. That's great clarification. I appreciate that. I think that's where we are at the end of this presentation. We've taken up almost a full hour. All our technologies worked. I think we got everybody. we got the message out as best we could. I'm in the basement. Deb's on her phone. John is actually probably got the best connection of all of us today. So I just want to thank everybody for being there. We have a number of other resources that are out there on our website. We have other webinars that we've done in the past. We've got a few different podcasts as well. We're going to do another one next week specific to monetization, rules of the road, and also we're going to look at the questions that people ask after this webinar and answer some of those questions on that podcast after this as well. We've got brochures that you can take away, and I'll tell you what, like everybody on this call, all we're doing is this right now. So to the extent you want to talk to us, we're more than available. We're talking to clients left and right pretty much all the time because timing is of the essence. I think it's important that everybody takes advantage of it for purposes of getting the benefits now to keep their businesses going. And so that's what we're here to help. Thank you.